Welcome back to the Deep Dive. Today, we are strapping ourselves in and jumping into the high-octane world of global alternative investment management.
It's a complex world.
It really is, and we're not going to just read you the dry corporate filings. Instead, we've taken a whole stack of sources, and really, we've tried to distill the strategic essence of one of the market's biggest and most influential players, Ares Management Corporation.
Right. And you have to understand, this isn't just some financial footnote.
No, not at all. This is a massive worldwide capital platform that is actively, right now, shaping private credit markets. It's determining the trajectory of private equity landscapes and moving billions, and I mean billions, in global real estate.
That's exactly right. And the source material you shared gives us this incredibly detailed look at Ares' evolution and, frankly, its immense scale. So our mission today is to go beyond just reciting the financials. We need to extract the strategic DNA, the why behind their rapid growth since 1997, how they ingeniously structured themselves for resilience, and, most critically, how their four massive business units interact to make them an absolute force, especially in that private debt market.
Okay, let's unpack this immediately with scale, because the magnitude here is, well, it's the starting point for everything else they do.
It is.
Ares Management, headquartered in Los Angeles, publicly traded on the NYSE as AACE. It's a fully entrenched S&P 500 component.
And that designation alone, being in the S&P 500, it signals they're a permanent fixture in global finance. It's a huge stamp of approval.
It is, and we were talking about financial mass that's, equivalent to a mid-sized nation.
That's not an exaggeration. As of November 2025, their global platform is reporting approximately $596 billion of assets under management, AUM.
Just let that number sink in. Almost $600 billion.
Right. Think of $600 billion being actively deployed, managed, and rotated across all these diverse global markets. That scale, it isn't just a big number. It grants them the ability to be an anchor investor in almost any large, complex transaction anywhere in the world.
And you can't handle that kind of volume with a small team. I mean,
Right.
The operational infrastructure required has to be colossal.
Oh, absolutely. They're operating with approximately 4,200 employees, and they're spread out across North America, Europe, Asia Pacific, and the Middle East.
So it's a truly multinational capital deployment machine.
It is, and the financials really back that up. This vast operation is highly productive. If you look at their most recent snapshot from 2024, they generated revenue of $3.885 billion.
Wow.
And the operating income was nearly $1 billion at $946 million, leading to a net income of $441 million.
So this deep foundation of consistent profitability, that's what's funding their aggressive expansion.
Exactly. It funds the expansion and their strategic moves into these, increasingly specialized and illiquid asset classes, which I think we really need to analyze in depth.
Okay, so that immediately sets the stage. They're massive, they're profitable, and they're global. Now, let's look at how this machine was actually built.
Let's do it.
Let's rewind to the beginning. So, Section 1 is all about the founding and the core structure. Ares was established in 1997. And this wasn't a startup built by one or two investment bankers.
No, not at all. It was built by what you could almost call a supergroup.
A supergroup, I like that. A team of 5 co-founders, Anthony Ressler, Michael Arrighetti, David Kaplan.
John H. Kissick and Bennett Rosenthal. The fact that there were 5 founders, especially in the high-stakes world of private capital, is really significant.
How so?
Well, it signals a built-in diversification of expertise from day one. They weren't just betting on a single strength like, say, distressed credit or classic private equity.
Right, we had a broader base.
They created a structure that allowed them to tackle credit, private equity, and real estate all at the same time. That ability to speak the language of all 3 major alternative asset classes, it just gave them a unique competitive edge really early on. They avoided that traditional silo structure.
And that strong collaborative founding group.
It
It seems like that created the kind of stable governance you need for long-term growth.
did. They grew as a private firm initially, but they very quickly attracted some serious institutional firepower.
Okay, and here's where the first really strategic maneuver comes in. In May of 2007, the Abu Dhabi Investment Authority, or ADIA.
One of the world's most powerful sovereign wealth funds.
Exactly. They acquired a minority interest.
Okay, but hang on. The Abu Dhabi Investment Authority took a minority stake, but explicitly waived governance or voting rights. Now, why would a sophisticated institutional investor like ADIA pass on that critical control? This is fascinating.
It really is. What's the thinking there?
ADIA is betting on the management team. Pure and simple. By acquiring a minority interest without demanding board seats or voting control, Ares successfully raised a massive amount of capital, a huge vote of confidence, without ceding any control over their strategic decision-making.
So they got the funding power.
Without any of the external complications of, outside governance, it kept the founders' vision completely intact.
That unified, unencumbered governance structure, that seems to have set them up perfectly for their eventual public life.
It did.
And that transition came with their initial public offering, their IPO, which was completed in May of 2014. And that marked the shift from a purely private, partnership-driven asset manager to a listed company on the New York Stock Exchange.
The IPO was a watershed moment. It didn't just provide liquidity for the existing partners, which is important, but critically, it gave the firm publicly traded stock.
Right, which is what we call acquisition currency.
Acquisition currency, exactly. And this currency is what allowed them to execute the aggressive multi-billion-dollar acquisitions that really define their growth story. Deals that would have been far, far harder to execute as a purely private entity.
But even before that IPO, the team was strategically building out some key operational components. And that really defined both their early focus and their geographic reach. Let's talk about Ares Capital Corporation, founded in 2004.
ARCC.
ARCC. For a lot of listeners, this is probably one of the most visible parts of the whole Ares ecosystem.
It's absolutely crucial. ARCC is crucial because it underpins Ares' huge footprint in U.S. middle market lending. Functionally, a BDC, or a business development company, is, well, it's essentially a public high-yield vehicle that's designed to fund American middle market companies.
Okay, so let's simplify some of that technical language.
Yeah.
The official description is a publicly traded, closed-end, non-diversified specialty finance company regulated as a BDC under the Investment Company Act of 1940. What does that mouthful actually mean for you, the listener, in practical terms?
Okay, so what it means is that BDCs are mandated by that 1940 Act to distribute a very, very high percentage of their taxable income to shareholders.
And that's where the high yield for investors typically comes from.
That's it. ARCC's specific mandate is providing financing for middle market acquisitions, recapitalizations, and leveraged buyouts, primarily in the U.S. They fill a critical financing gap. They act as this sophisticated non-bank lender for businesses that have, outgrown small business status but aren't quite large enough to easily tap the public high-yield bond markets.
So they're basically providing that crucial private financing backbone for the U.S. engine room.
A perfect way to put it.
And this is all managed through Ares Capital Management, LLC, the SEC-registered investment advisor to the BDC, which ensures compliance and clear operational lines.
Precisely. The structure is built for capital management and risk control within that established U.S. regulatory framework. But this early engine was geographically limited.
To the U.S.
Right. And Ares knew that true dominance required a global perspective.
Which brought the strategic focus across the Atlantic in 2006 with the founding of Ares Management Limited.
This was their formal expansion into Europe. Ares Management Limited focused specifically on European capital markets operations. And it's critical to note they immediately sought authorization under the Financial Conduct Authority, the FCA, in the UK.
So this isn't just about opening an office in London.
No. It's about establishing a fully regulated, fully compliant presence in one of the world's major financial centers. So by 2006, they had the foundation in place, U.S. private debt mastery, and a regulated European outpost. This laid the essential groundwork for the explosive growth that followed.
Right. Once that initial governance and foundational structure was set, Ares needed to scale up and fast. And that brings us to Section 2, a strategic playbook built on using acquisitions to instantly buy market expertise, geographic reach, and just massive asset accumulation.
Yeah, and the first indicator of their market power actually came before the biggest acquisitions. In April of 2016, they successfully closed their fifth global private equity fund.
And this is a big one.
A huge one. They raised a staggering $7.85 billion. That figure alone speaks volumes. It shows overwhelming investor confidence in Ares' ability to deploy capital profitably, and it legitimized their shift from being just a debt-focused firm to a genuine multi-asset alternative manager.
And they used that massive momentum to launch their first industry-shaking move, the American Capital acquisition. The plan was announced in May 2016 to buy the asset management company American Capital for US $3.4 billion. It closed in January 2017.
This was a defining, absolutely pivotal moment for Ares, and I'd argue for the private credit market in general.
Why so significant?
because American Capital was a major player in the BDC and private credit space, just like Ares.
All right.
So this acquisition, it wasn't just about adding assets. It was about industry consolidation. It was about eliminating a major competitor.
So for $3.4 billion.
For $3.4 billion, Ares instantly achieved a massive scale increase in their credit and private equity portfolios. They acquired a huge portfolio of existing investments and, crucially, they locked up all these new client relationships. It fundamentally reshaped the landscape of the private debt market. It confirmed Ares as the undisputed leader in U.S. middle market financing.
So that deal was all about consolidation and scale mastery in North America. But their next move was purely geographic. It was a thrust to the east with the SSG Capital acquisition.
The Asia-Pacific strategy. And again, look at the playbook. Rather than spending a decade slowly building a presence in Hong Kong or Singapore,
Which would be the traditional way.
right. Instead, in January 2020, Ares acquired a controlling stake in the established Hong Kong-based alternative investment firm SSG Capital Management. This was formalized in July 2020, and the unit was renamed Ares SSG.
So why was acquiring SSG the smart move rather than just building organically?
Speed and expertise. I mean, the Asian markets are uniquely complex. You need specialized knowledge of local regulatory environments, of distressed debt mechanisms, of regional business cultures.
You can't just parachute people in.
You can't. So by purchasing a controlling interest in an already operational, already successful firm like SSG, Ares instantly gained a deep pipeline and local expertise across the entire Asia-Pacific region. This just accelerated their global strategy dramatically. It gave them immediate capability in credit, private equity, and special situations all across APAC, which really rounded out their global reach.
Okay, so rounding out their expansion strategy, they looked inward at specialized asset classes. In July 2021, Ares completed the acquisition of Black Creek Group's U.S. real estate investment advisory and distribution business.
And this shows a highly targeted effort to bolster their real estate group's capacity, which we're going to detail in a moment. While Ares already had a real estate arm, Black Creek brought two specific things to the table. One, advisory expertise, and two, specialized distribution capabilities.
Distribution meaning?
Meaning it strengthened their ability not only to find and finance real estate assets, but also to package and sell those investment products to a wider range of investors in the U.S. It deepened their vertical integration. And, importantly, it laid the groundwork for that massive, complex, global real estate deal that followed just a few years later.
So we're seeing a really clear pattern here. Consolidating power and credit with American Capital, achieving global reach with SSG, and then deepening asset class specialization with Black Creek. That is a very sophisticated playbook for growth.
Absolutely.
So now we get to the core of the business, Section 3, the investment engine. And it's absolutely essential to remember, as we've said, that Ares is among the largest players in the private debt market. All their activities flow through 4 distinct yet complementary business units.
And that complementarity is their secret weapon. It really is.
That ability to pivot.
That's the key competitive edge. The 4 groups are designed to operate as a full-stack capital solution. It allows Ares to shift capital, to manage risk, and to exploit opportunities based on global market conditions. So if one unit slows down, the others are positioned to capture the value somewhere else.
Okay, so let's start with the largest component, the Ares Credit Group.
Let's do it.
The credit group is the foundation. It was immense, even back in May 2016, reporting $60.0 billion in assets under management. It dwarfed the other groups at the time and really confirmed the firm's origin in private debt mastery.
The credit group is the engine room. Its core focus is managing both liquid and illiquid credit, and it operates squarely in that high-yield, non-investment grade credit sector. This is the world where capital is most needed and, frankly, where Ares generates its highest returns. It's high risk, high reward.
What's fascinating is the sheer diversity of instruments they manage within that single sector. It's not just one thing.
No, they are comprehensive. The categories are vast. Corporate loans, high-yield bonds, institutional credit, credit opportunities.
Which means capitalizing on temporary market distress.
Exactly. Then there are special situations, which are more complex, deeply troubled companies, asset-backed lending, and of course, direct lending. And they do this across both the U.S. and Europe. Basically, if a company needs non-traditional structured financing, Ares has an offering.
And the execution model in the U.S. is largely defined by the structures we mentioned earlier, right?
Correct. The U.S. corporate lending is primarily run through Ares Capital Corporation, the BDC, and a separate commercial finance business.
And that commercial finance business is specialized.
Very specialized. It provides asset-based loans, so lending against the value of inventory or equipment, and cash flow loans, which is lending based on projected future earnings. This dual approach means they can finance almost any type of middle market company in North America, whether it's stable or, in a high growth phase.
So how does that self-origination model differ when you look at Europe?
In Europe, the focus shifts. It's more about self-originated investments in illiquid middle market credits. They don't rely as heavily on the institutional market for deal flow. They are actively out there sourcing, structuring, and negotiating debt packages directly with the companies themselves.
And what's the advantage of that?
That hands-on approach minimizes competition, and it allows Ares to control the terms and the structure of the debt right from inception. These are managed through commingled funds, separately managed accounts for their massive clients, and joint venture lending programs, which spreads the risk and increases their deployment capacity.
So this makes the credit group a globally adaptive proprietary machine. It's designed to find value wherever traditional banks have retreated.
Precisely. They're built to exploit those crucial pricing inefficiencies and the regulatory differences between the U.S. and European debt markets.
Okay, so let's move to the second pillar, the Ares Private Equity Group. In 2016, this had $23.3 billion in AUM. The synergy here with the credit group seems to be what sets Ares apart.
It is. The strategy is targeted and complementary. The private equity group makes opportunistic majority or shared control investments, and they focus principally on, you guessed it, undercapitalized middle market companies.
There's that recurring theme again. The middle market.
It is.
This allows them to be the full-stack capital provider. So if a deal is too risky for their credit funds to provide the debt, they can instantly pivot and offer an equity stake, or vice versa. It gives them a competitive bid advantage over those single-focus firms that only do one or the other.
Exactly. That is the competitive differentiator. They can sit down with a struggling or a growing middle market company and offer a completely tailored solution. Cheap debt, expensive debt, preferred equity, or a full equity buyout. They're seeking companies that need a capital injection and a strategic restructuring. This allows them to capture value where the traditional private equity mega LBO houses just aren't interested.
And within PE, they've carved out a really fascinating specialization in U.S. power and infrastructure assets.
This is a huge strategic move toward recession-proofing their portfolio. They manage investments in vital sectors like power generation, transmission, and midstream assets.
So we're talking pipelines, processing facilities.
Exactly. These are essential services. They're often protected by regulation or long-term contracts, which provide highly stable, almost annuity-like cash flows. And institutional investors, they love that stability, especially when markets get volatile.
And how do they structure these PE investments? What are the vehicles?
They utilize 4 corporate private equity commingled funds, mainly targeting North America, but with a presence in Europe as well. For the infrastructure play, they manage 4 commingled funds and 6 related co-investment vehicles.
And the co-investment vehicles are key.
They are key because these vehicles allow their largest institutional clients, pension funds, sovereign wealth funds, to participate directly alongside Ares in specific high-conviction infrastructure deals. And that dramatically deepens those critical client relationships.
Okay, next up is the Ares Real Estate Group. It had $10.2 billion in AUM back in 2016, and it's grown substantially since then, especially after the targeted acquisitions we talked about.
The real estate group provides critical diversification. It moves away from purely corporate balance sheets and into physical, tangible assets. Their strategy is broad. They manage both public and private equity and debt investments in real estate across both North America and Europe.
So just like with corporate financing, they can play both sides of the ledger in the property markets.
Exactly.
They can provide the senior debt for a massive project, or they can take an equity ownership stake in the underlying office tower or apartment complex itself.
Precisely. That dual capacity allows them to be flexible, regardless of where the greatest value is being generated in the current cycle. Is it in the low-risk debt portion or the high-upside equity portion? They manage several investment vehicles here, and they reflect that diversity.
So tell us about those vehicles, especially how they ensure liquidity for investors.
Well, they operate their own publicly traded REIT, Ares Commercial Real Estate Corporation. The existence of a public REIT provides investors with a liquid way to access commercial real estate debt and equity. It balances out the illiquidity of their private funds.
Makes sense.
Then they also manage U.S. and European real estate private equity commingled funds for more opportunistic investments, and highly customized real estate equity and debt separately managed accounts for their most sophisticated, tailor-made clients. The Black Creek acquisition was specifically designed to enhance their capabilities in distributing these products to a wider audience. It was preparing them for future global scale.
Okay, finally, we revisit Ares SSG, the specialized Asia-Pacific arm that was formed from that 2020 SSG Capital Management acquisition.
Ares SSG is the essential fourth pillar. It functions as the specialized, localized extension of the other three groups: credit, private equity, and real estate, but it's tailored specifically for those Asia-Pacific markets. Its mandate focuses explicitly on credit, private equity, and highly complex special situations investments across that region.
So if a distressed debt opportunity comes up in Singapore or a growth equity play emerges in Korea, this is the team that executes it. They're using their local knowledge and expertise.
Absolutely. It completes the global strategic map. You have the massive U.S. credit and PE machine, you have the regulated European platform, and now you have the specialized Asia-Pacific arm. This triple continent reach, governed by four complementary pillars, it positions Ares to deploy capital 24 hours a day, capitalizing on market shifts regardless of geography or asset class.
That robust structure and capital flexibility, it really allowed Ares to pursue increasingly massive and diverse deals in 2024. And these moves, they aren't just incremental adjustments. They are strategic leaps that demonstrate their evolving appetite for new asset classes and just sheer size.
2024 was a banner year. It really showed Ares leveraging their global scale and their willingness to enter markets where, others might fear to tread.
So first up, in June of 2024, Ares Management, in cooperation with Searchlight Capital, invested $500 million in a preferred equity transaction in RSK Group.
And this is a perfect example of how the private equity group applies its strategic focus. RSK Group is a UK-based environmental, engineering, and technical services group.
Right.
This sector is incredibly resilient because it's driven by non-discretionary spending. Things like environmental compliance, infrastructure maintenance, essential engineering. These investments benefit from these powerful, long-term regulatory tailwinds related to sustainability.
And the type of investment preferred equity is highly strategic, isn't it, for both Ares and for the company?
It is. Preferred equity sits senior to common equity. It often offers a guaranteed dividend or return, but it still retains the upside potential of equity. So it allowed Ares to gain exposure to the growth of this essential services company, locking in returns, while also enabling RSK Group to raise a huge amount of capital for expansion without immediately diluting the control of its existing common shareholders.
And the total investment even increased a bit to $520 million.
It did, which really underscores Ares' deep commitment to this essential infrastructure and environmental services space as a stable, long-term asset class.
Okay, next came a transaction that immediately solidified their position in global real estate and logistics. In October 2024, Ares acquired the international business of GLP Capital Partners, or GCP, excluding its Greater China business.
This was a colossal play. It specifically targeted the high-growth logistics real estate sector, which has just been booming since the global supply chain shifts of the pandemic.
A huge deal.
And the transaction demonstrates their tremendous firepower. The deal was valued at approximately $3.7 billion in cash and another $1.9 billion in Ares Class A common stock.
The scale is immense, but the use of their own stock as currency is just as important as the cash component, right?
Absolutely. Utilizing $1.9 billion of your own Class A stock shows that Ares has immense confidence in the valuation of its own shares. It's an efficient way to close a deal of this magnitude without completely draining the balance sheet of cash.
So what do they get for that?
Critically, acquiring GCP's international business instantly provided Ares with a massive, high-quality portfolio of logistics and real estate assets outside of China. And remember that 2021 Black Creek acquisition?
Yes, the one to beef up distribution.
Exactly. That move beefed up their real estate distribution capabilities, making them competent enough to integrate this far larger global logistics platform from GLP 3 years later. This is truly strategic, long-term planning coming to fruition.
It instantly upgrades their real estate group from a regional player to a global logistics powerhouse.
It's a game changer, a complete game changer in terms of AUM and global influence in the institutional real estate market.
And finally, we arrive at the deal that truly captured the public imagination. December 2024. Ares acquired 10% of the Miami Dolphins of the National Football League.
This raises a really important high-level question for institutional investors, which is, why does a 10% stake in a single sports team warrant so much attention?
It's a great question.
The significance here, it really transcends the dollar value. This was one of the very first deals allowing outside investors, specifically private equity firms like Ares, to buy into an NFL franchise.
And that market entry was only possible because the league owners voted to allow these new types of institutional investors back in August 2024. They essentially opened up a hyper-exclusive club.
And Ares acted incredibly fast to secure that first mover advantage. Professional sports ownership, especially in major leagues like the NFL, has historically been restricted to a very, very small circle of family groups or ultra-high net worth individuals.
Right.
The August vote opened the door to institutional capital, and Ares jumped right through it, immediately. This is a landmark transaction because professional sports ownership represents an asset class defined by extreme scarcity, massive brand equity, and constantly appreciating media rights contracts.
So for Ares, this isn't about running the team or picking the quarterback. It's about pioneering a brand new, highly desirable asset class for their global institutional clients.
It validates the NFL's decision to modernize the capital structure of its franchises, and it demonstrates Ares' ability to execute complex, precedent-setting deals in these highly visible sectors. It signals to the entire investment world that professional sports teams, which were once seen as vanity projects, are now legitimate institutional-grade assets. This deal is perhaps the clearest sign of Ares' relentless hunt for the next frontier of alternative investment.
So let's bring it all back together. We've charted the course of Ares Management Corporation. We started with 5 founders back in 1997, building regulatory platforms in the U.S. with Ares SSG and in Europe, and then executing this really strategic blueprint of acquisitions.
A very clear blueprint.
Consolidating credit with American Capital, achieving global reach with SSG, and then deepening real estate expertise with Black Creek and now GLP.
The core takeaway here is that the growth of Ares is not random. It's a deliberate strategy of massive diversification across 4 highly focused, often complementary segments: credit, private equity, real estate, and SSG, all coupled with aggressive geographic expansion. They are the market's capital architect. They're willing to provide these sophisticated capital solutions in places where traditional banks or public markets want or simply can't go.
And they're consistently focusing on that illiquid private debt and middle market company space.
That's their sweet spot.
This strategic vision leads us directly to the core question for you, the learner, that builds on everything we've discussed. Given Ares' significant presence in illiquid credit and its role as a BDC financing middle market companies, how does the ability to instantly shift capital across 4 distinct global segments allow them to proactively manage risk and capitalize on varying economic cycles and regulatory environments worldwide?
That structural flexibility is their competitive moat. I mean, that's what it all comes down to. The 4-pillar structure isn't just an organizational chart, it's a dynamic risk mitigation strategy.
So how does that play out in practice?
Well, if U.S. private equity deal valuations get too rich, they can pivot resources to opportunistic European direct lending. If the Asian credit market presents special situations driven by regulatory changes, Ares SSG is immediately positioned to execute on that. It allows them to arbitrage opportunities across asset classes and geographies, ensuring stable, high returns even when specific markets are facing severe headwinds. This ability to rotate capital is why they remain such a dominant force.
Fascinating. And finally, let's end with a provocative thought that builds on the recent activity we've seen. The investment in the Miami Dolphins confirmed that these hyper-exclusive, scarce asset classes are the next frontier for alternative managers.
They certainly are.
So, considering the success of the NFL deal, what other unexpected industry currently closed off by tradition or restrictive ownership rules might Ares, or its peers, aim to penetrate next? Think of asset classes with high barriers to entry, massive brand recognition, and appreciating intrinsic value. Following that playbook of the NFL deal, it's really a question of where the next $1 trillion of institutional capital will find its new home.
Something to mull over as you think about the future of global investing.
Thank you for joining us. We hope you feel thoroughly well informed about the global strategy of Ares Management Corporation.